Good to have you both on. Terry, I'm going to start with you. The rate reprieve we've been seeing with the 10-year now at 4.649%. Does this continue from here? And what is contributing to it? Is it geopolitics and this idea of safe haven play, or is it the Fed speak and all this jawboning suggesting that perhaps rates don't need to go higher?
Well, it's all in the above in respect of the reasons. But let me try to address the first question first, which is this going to continue? I think that's highly contingent on whether we continue to see disinflation in the U.S. economy, and also if we get to see a slowdown starting over the next few months. We do believe there will be a slowdown. We think that it will be significant. It will be consumer-led. And if you look at the post-World War II recessions in the U.S., I believe there have been about 15 of them. There really have only been 2 in which 10-year bond yields did not fall from the peak to the trough. So if this is even a mild recession, the baseline view should be to expect that the 10-year yield will continue to fall. Again, all of this is contingent on whether you believe there will be a slowdown and or a recession. As far as what's causing yields to come down today, I think that has to do with the Fed and the Fed commentary that's come out over the last few days. But if you're asking me, what has triggered a more dovish tone coming out from some of the Fed speakers, I would say that the employment report from Friday was actually very much looking like a Goldilocks employment report, with the average hourly earnings posting no more than a 0.2% gain on the month. That was a very conducive situation, right? You saw payrolls growth be strong, but you saw wage growth be weak. That's exactly the kind of situation the market wants to see.
Okay. Matt, as we've seen yields fall, we've seen stocks rise. Does this rally have legs here? We've been talking about seasonality. Are we hitting that moment where the tide turns in October, or is it something else afoot?
Well, I'm glad you went to Mr. Wizman first, because the bonds are really driving the stock market. The bond market's in charge from here, no doubt. We see that most of equity returns are being driven by bond market action. So certainly if bond yields settle in here, move a little bit lower, that's going to be constructive for stocks. I think we had a relief rally last week when things like in the bond market seemed like they were getting out of control. So that set a nice constructive tone. Then we move into earnings, which look like they should be okay. So near term, things okay. When you get out a little longer term, I think things get a little bit more complex.
Terry, this market reminds me in the equity side of a game of Jenga, right? You keep taking out pieces, but the market hasn't fallen over. If there is a recession, though, on the yield side, and yields do come down, as you said, that might be good for equities, unless it's a dramatic slowdown. You don't seem to necessarily have a view on how dramatic that slowdown might be?
Look, my view is that if we do have a slowdown, it's going to be a consumer-led slowdown. I think the consumer right now in the U.S. is the weakest part of the economy. Certainly, it's not business investment that's being supported by policy. And I think by the time we do see the slowdown in the U.S., the rest of the world might actually be doing okay. So our export growth might be okay in the U.S. I don't want to intone too much on the depth of the recession that we see, or for that matter, the slowdown. It doesn't have to be a recession. I think it will feel like a recession for the consumer. And I think the reason that bond yields can conceivably go down in that environment, even if we don't see a recession, is because, remember, if the consumer is weak, pricing power for consumer companies will be weak. If pricing power for consumer companies is weak, the things that we measure in the consumer price indexes, whether it's the CPI or the PCE deflator, will be weak as well. After all, what we're measuring there are consumer prices. So I am not just betting on a slowdown in the consumer taking bond yields lower. I also do believe that there is going to be a continuation of disinflation in the U.S. That, in fact, might be led by shelter price inflation coming down, as well as the broader complex of consumer prices.